Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we are cracking open one of the most interesting and, frankly, one of the most premium-priced companies in the industrial space, AMETEK, Inc., ticker AME. On the surface, it's a fantastic business, a highly disciplined compounder, but with a market cap over $45 billion and trading at more than 31 times earnings, the real question for us is this. Are the company's competitive advantages so powerful that they justify a price that demands flawless execution? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So you get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comments section.
Perfect. Now let's get into it. This core tension you mentioned, it's really the place to start.
Exactly.
Okay, so you look at their Q3 numbers for 2025. Record sales, right?
Yeah.
$1.89 billion, up 11%. Looks great.
EPS is up 14%. Hard to argue with that.
You can't. But when you peel back that top layer, you see this divergence.
The split between total growth and organic growth.
Precisely. The total growth is, well, it's being supercharged by M&A. That's the compounding engine.
Right.
But the organic growth, what the businesses they already own are doing, that's stabilizing.
In the low to mid single digits, I think it was 4% last quarter.
4%. So the whole debate about this premium valuation, it really hinges on one question. Is their business model unique enough to keep generating elite returns even when the underlying growth is just? Okay, that's the challenge.
And that brings us right to their structure, what the source material calls the Federated monopoly. It's a bit of an anomaly. This isn't your grandfather's GE, some top-down centralized behemoth. It's more like a federation of these tiny tech monopolies.
All split into two main groups, right? The Electronic Instruments Group, or EIG, and then the Electromechanical Group, EMG.
Exactly.
And that structure, that's their secret sauce for avoiding the classic conglomerate discount.
Where the whole is worth less than the sum of its parts because of bureaucracy.
Exactly. Centralization just strangles innovation. AMETEK figured out this really brilliant hybrid model to get around that.
So walk us through that. How do they stay agile when they're so huge?
Well, they decentralize the P&L, the profit and loss responsibility. So if you're the manager running, say, KAMECA in France, you have real autonomy.
You're making decisions on product, on pricing for your local market.
You are. It keeps that founder's mentality alive. They're still hungry. They're still quick. They're not buried under corporate memos.
Okay, but then how does the center hold? How do you stop it from just becoming, dozens of inefficient little kingdoms doing their own thing?
That's the stroke of genius. While the P&L is decentralized, the operational framework is completely centralized. It's mandatory.
The AMETEK growth model.
Every single business unit has to follow it. The OpEx strategies, global sourcing, design for Six Sigma, all of it. So they get the efficiencies of a massive corporation-like buying power, but the agility of a small, nimble company.
The best of both worlds. Okay, so let's get into some of these subsidiaries because this is where you really start to understand the valuation. It's all about becoming a monopoly in a tiny pond. Let's start with KAMECA, the atomic gatekeeper.
KAMECA is probably the best example in the whole portfolio of a nearly unbreakable moat.
Yeah.
They make these incredibly high-precision microanalytical instruments.
We're talking about things like atom probe tomography.
Yeah, things that can map out the chemical composition of a material down to the atomic level.
So if you're making a 3-nanometer semiconductor chip, you basically have to use their gear.
You have to. They are the global standard. So let me ask you, if you're running a multi-billion-dollar semiconductor fab, why not just buy a cheaper machine from a competitor?
That's the question. And the answer is the data. It's the historical data library.
Tell me more.
If you switch away from KAMECA's platform, you effectively invalidate your entire history of research. Decades of quality control data, process validation, it all becomes useless.
It's a non-starter.
A complete non-starter. The cost isn't the price of the machine. The cost is the destruction of your institutional knowledge. It's an astronomical switching cost.
And you see that same principle just applied differently with another EIG company, ZYGO Corporation. They're the standard in optical metrology.
Yeah.
Laser interferometers.
Measuring surfaces with, what, sub-nanometer accuracy? Again, crucial for things like high-end lenses or semiconductor wafers.
Right. And here the lock-in isn't so much the physical data, it's the software. It's
Yeah.
all about their MX software platform.
So the engineers build their entire workflow around ZYGO software.
That's it. It's the software glue. To replace the hardware, you'd have to rewrite the entire quality assurance database. You'd have to retrain your whole staff. No production manager on earth is going to take that risk.
The risk of a quality error is just too high.
It's way too high. They become completely insensitive to the price of the machine because the alternative is so much more expensive and risky.
Okay, one more example. Rauland in the healthcare space. They make nurse call systems, the Responder 5 platform. Now, lots of B2B companies have some lock-in. What makes Rauland's moat so deep?
It's the depth of the physical integration. This isn't just a button on the wall. It's a full clinical workflow platform.
Connecting nurses, doctors, electronic medical records.
All of it. And crucially, those systems are wired deep inside the hospital's walls. We're talking about cables running through conduits.
So the moat is literally concrete and drywall.
Exactly. To rip out and replace that system in a hospital that's running 24/7, it's a logistical nightmare. It's a regulatory nightmare. The replacement cycle is measured in decades.
Which gives them incredible pricing power on upgrades and service.
Massive pricing power. And this all comes back to their core strategy. Be the big fish in a small pond. They intentionally go after these niche markets, often under $500 million TAM.
So big players like Siemens just don't bother to compete. It's not worth their time.
It's not worth the capital allocation.
Sure.
This lets AMETEK operate with monopoly-like profits without attracting the attention that a true monopoly would.
So those moats secure the profits. Now let's talk about the cash those profits generate. This is the financial engine, the asset-light model.
And this is where they are truly elite. Their free cash flow conversion is consistently over 100% of net income. It was 129% in 2024, 113% in Q3 of 25.
And that's not just a lucky quarter, it's structural.
It is. It's driven by incredibly low maintenance CapEx. We're talking like 1.5% of sales.
Why so low?
Because they're not a heavy fabrication business. They don't have foundries or giant robotic assembly lines. They're mostly an assembly and test operation. They buy components, they integrate them, they test them, they ship them.
So their depreciation charge is often bigger than their actual cash outlay for new equipment.
Exactly. And that accounting difference gives them a structural boost to their free cash flow. It's just a fire hose of cash they can then use for acquisitions.
Which is the main growth engine. And we've seen them shift from that string of pearls strategy, lots of small deals, to bigger platform acquisitions.
The Paragon medical deal, $1.9 billion.
A huge pivot into MedTech.
A critical deal. It was transformative for the EMG group. Paragon makes single-use surgical tools, implantable components. Their moat is the FDA.
Regulatory lock-in. Once your medical device is approved with Paragon as a supplier, changing that supplier is a massive headache.
A costly, high-risk headache. So that acquisition immediately pushed EMG's margins from the mid-teens to over 25%. It showed they can not only buy great assets, but integrate them perfectly.
And that discipline comes from how management is paid. They're not incentivized to just get bigger.
Absolutely not. Their compensation is tied directly to return on invested capital, ROIC, and EPS growth. No empire building. They have to make smart capital decisions. And they keep that ROIC in a very healthy 12-16% range.
Okay, so this brings it all back to you, the investor. We have a world-class business, deep moats, an incredible cash engine, but we have to talk about the price.
Yeah, the valuation problem.
It's trading at around 27 times forward earnings. The market is demanding perfection.
There is zero margin of safety in that price. Zero. Your earnings yield is about 3.7%. The 10-year treasury, the risk-free rate, is hovering around 4%.
So you're getting paid nothing, or even less than nothing, to take on the risk of owning a company. All of your return has to come from growth.
Which brings us to the bear case, the roll-up trap. The argument is that AMETEK is really just a very sophisticated financial engineering project that's masking low organic growth.
And the evidence is right there in the numbers.
It is. 11% total growth, but only 4% organic growth. The rest is all M&A. And as they get bigger, past $7 billion in revenue, the law of large numbers kicks in.
They need bigger and bigger deals just to move the needle.
Which means more integration risk, more financial risk. And what happens if that organic growth stalls out completely? Or a big deal like Paragon goes sideways?
The whole narrative shatters.
It fractures instantly. And the market could easily re-rate this thing from 27 times earnings down to a more normal industrial multiple of, say, 20 times. That alone is a 25–30% drop.
Wiping out years of gains. And we can't forget they still have some cyclical exposure, despite the high-tech feel.
They do. About a quarter of their sales are tied to aerospace, so they're exposed to Boeing and Airbus build rates. And EMG has exposure to factory automation, which is very cyclical.
Okay, so what could justify the price? What are the catalysts that could push it even higher?
I see two main ones. The first is what you could call a MedTech re-rating.
The market stops thinking of them as an industrial company and starts thinking of them as a life sciences company.
Exactly. If investors start comparing AMETEK to Danaher or Thermo Fisher, which trade at 30–35 times earnings, well, then suddenly today's price looks reasonable, maybe even cheap. The whole valuation floor rises.
And the second catalyst
Is just interest rates. As an active acquirer, lower rates are pure tailwind. It makes their M&A math much, much more attractive.
So let's bring it all together. The final verdict.
Look, this is a Tier 1 A+ quality asset. The moats are real, the cash flow is elite, but it's trading at a wide-awake price.
Yeah.
The market knows it's a great company.
So for anyone looking to start a position, what's the action plan?
You have to be disciplined. Our recommendation is to accumulate on weakness. Set your target in the, say, $170 to $180 range.
Which would bring the multiple down to a more reasonable 23–24 times earning.
Exactly. Gives you that margin of safety you need. You get to own the quality, but you're not paying the full premium for perfection.
And before we go, I want to leave everyone with one last thought. A potential hidden catalyst. Everyone is focused on the MedTech story, but take a look at their power systems business. The global build-out of these massive AI data centers requires incredibly clean, regulated, sophisticated power.
And testing equipment.
Could AMETEK's programmable power business be a forgotten picks and shovels play on the entire AI infrastructure boom? It's something worth digging into.